In this class we're going to talk about growth strategies, and more specifically we're going to talk about horizontal and vertical integration. Now, in order to see what's meant by this, let's consider some companies, and say the companies are working in this type of configuration. So we have companies A, B, C, D, E and F, and they're organized in this way because they are structured as being near the consumer or near the sources of raw materials. So we can envisage the structure of the industry, if you like, to be at three stages. Company E and F, or companies E and F, are close to the market, so they may be perhaps retail outlets or companies selling to the final customers. C and D, well, these could be the companies that are making the products and perhaps distributing the products. And companies A and B, these are companies that supply the raw materials and the resources necessary to make the products. So now we have a picture of how this industry is configured. Company E and F, very close to the market, companies that deal with the final customer. C and D are the companies that make the product. They make the product and perhaps sell the product to companies E and F. And companies A and B supply the raw materials. They sell to companies C and D. So A and B sell to C and D, and C and D sell to E and F. And in that way the raw materials are processed into production and sold on to the final customer. Now we classify this as forward vertical and backwards vertical integration. So if we take, for example, Company D, if we move forward towards the customer, we go vertical forward. And vertical forward are represented by the two arrows. I'll just put the cursor onto the screen. These two arrows here. So they're moving closer to the customers, so it's vertical forward. It's vertical forward. But the company also could go backwards. It could, for example, let's say Company D bought Company A. It would be vertical backwards, because now it would have the raw materials and it would be making the product. If Company D bought Company F, it's vertical forwards because it's now selling to the final customer and making it. So vertical integration means the business is moving closer. Vertical forward integration, I should say, is moving closer to the customers. Vertical backwards integration means it's starting to supply the raw materials, and it has procured the raw materials. So there are different ways in which the business may move. Vertical forward, vertical backwards. And it can go to D can go to E, which is vertical forward, or D can go to A, vertical backwards. It's also possible for a business to go horizontal. In other words, a company manufacturing the product, let's say C, acquires the other company manufacturing the product, D. And the reason for that is because they could share the capital, share the expertise, and they could also become a big company at that level. So it's horizontal integration. And this may happen at raw material level. The companies combine, which is horizontal integration, or indeed at the final stage it could be horizontally integrated E and F. So two retailers, let's say, come together, they're selling the same product and they form a bigger outlet. That's horizontal integration. So now we have a picture of what's meant by vertical integration and horizontal integration. Let's go into a little bit more detail and talk about horizontal integration for the moment. This method of growth involves companies merging with other companies who produce similar products or services. So it's the same type of business coming together. This is mainly done through external growth, for example mergers and acquisitions. One company forms a relationship or buys up another company at the same level. It merges perhaps, or it acquires, depending on which way it goes about it. Examples of horizontal integration may be a local food supermarket buying a local DIY hardware store. So now the food supermarket can sell some DIY, and DIY outlets may start to stock some basic items of food. So it's horizontal integration. Both of them are buying their produce from the producers, the manufacturers, and they're selling it on to the final customer. Both the local food market and the local DIY are close to the market. They are close to the final consumer. Now the benefits of horizontal integration, well, there are economies of scale. They're combining, so they may be able to rationalize their administration or reduce overheads, reduce office overheads, or they may be able to purchase in bigger quantities and negotiate better discounts, and so they're able to gain economies of scale. And they've also got economies of scope, sharing resources and activities. They're able to come together to share the resources in a more efficient manner. They have an increased market presence, so they're able to dominate the market more, and they're able to get a higher profile in the market because of their size. And it's possible that they could reduce costs by operating factories in foreign markets. If they're selling a lot in the domestic market, they may start to produce the product themselves, perhaps in overseas, in cheaper production centres overseas. They may establish businesses to produce, and in this way supply the product to the final customer right from start to finish, because they are now strong enough to be able to produce products themselves that meet customer requirements. Now there are problems associated with horizontal integration. For example, there might be legal issues. Antitrust may cause problems with this type of integration. If companies become too large and start to operate against the customer interests, against consumer interest, if that's the case, then the government may look into mergers that have come about in this fashion. If it's against the public interest, against the customer, it's forcing up the price perhaps, or reducing the quantity, or reducing the quality of the product, then the government may become involved. Then there may be legal issues, legal barriers to this type of integration. And if it's unplanned, it can go wrong. It needs careful planning. It just can't happen quickly and without due planning. It's important that the strategy of the business accommodates this type of integration. The strategy of the business has allowed for this, it's planned for, and its implications have been worked through in advance, so the business does not meet any unforeseen circumstances that may damage the business. So it requires full and effective planning. That's essential. Now let's turn our attention to vertical integration. the level of which a company owns its upstream, this is the level of which the company owns its upstream suppliers and its downstream buyers, is a measure of its vertical integration. Companies may move forward towards the customer or backwards towards the raw materials. And that's what we mean by vertical integration. If the company moves closer to the market, it is vertically integrating. It's moving from, perhaps, say, from production to also selling the product. That's vertical integration. A vertically integrated company operates at different levels, close to the customer and away from the source of raw material, or vice versa. So a vertical integrated company may move towards the market or towards the raw materials. If it has enough resources, it may do both. It may control raw materials, produce the item and sell it. Now that's complete vertical integration. That's taken in all the levels: raw materials, production and selling to the final customer. Generally speaking, however, it happens that a producer starts to sell. It still buys the raw materials, makes the product from the raw materials and then sells to the customer. And that's normally what we consider to be vertically integrated. The process of vertical integration, well, there are two forms of vertical integration. Expansion downstream refers to forward integration, and expansion upstream refers to backward integration. So upstream is moving towards raw materials, downstream moving towards the market. It's just expressions that are used in the literature. So downstream means moving towards the customer, and upstream towards raw materials. For example, if a fruit retailer acquires a fruit farm, that would be considered as backward integration. It's moving backwards. It's moving upstream. It's moving towards the source of raw materials. If a fruit retailer acquired a canning plant, that would be considered as forward integration. Perhaps the fruit retailer needs to widen its market, so it would produce the produce. It's a producer, and then it cans the items for resale, and it may retail it, in which case it's got all three levels. It grows the crop, it cans it, and it sells it. That would be complete integration, covering the three levels. The cost of market transactions between companies. Well, it may be cheaper to move between production stages in one company. So it may be the case that instead of acquiring different companies at different levels of production, say the company that produces the raw materials and then the companies that sell, perhaps the company that manufactures the product might want to start acquiring its own raw materials or starts to sell directly. So it might be better to do it within the company as opposed to acquiring other companies. Now, the advantages of vertical integration. Well, vertical integration reduces transportation costs. It's possible relocation of companies to reduce cost. Transportation costs would be reduced if one single company was to make the product and perhaps sell the product. It's able to organize its distribution in a way which is more efficient. It's perhaps taking everything into one plant. If you can control raw materials and the logistics of supply of raw materials into the production plant, it's able to do so perhaps more efficiently, smoother schedules and better production planning. So it may reduce transportation cost, which may, as I've just mentioned, improve the supply chain. So a vertically integrated company will have more control over the supply chain. It knows what is being produced, the raw materials, it knows what it has the capacity to produce in terms of manufacture, and perhaps it even knows what the customers want. So the whole supply chain could be better managed. And there may be better opportunities to differentiate the product because there's more control over the inputs. Perhaps the company wants to buy the raw materials, but it wants to buy them in a slightly modified form which will enable it to develop different products. Well, before it integrated backwards towards the raw materials, it had to take what the suppliers gave it. But when it's integrated, it may be able to design the outcome of the product more in tune with what the customer needs. And right from the start, from the raw material stage right through production and distribution, products could be better tailored to what the market wants. And of course, if the company is vertically integrated, perhaps all the way from raw materials right through to the final customer, if that's the case, then of course it's taking the profit margins for the companies that would have been in place had the business not been vertically integrated. If there were companies operating at the raw materials level, at the production level and at the distribution level, each of the companies are producing a profit. Well, if one company now controlled all the stages from raw materials, production and distribution, then of course those profit margins will now flow to one company. So it's more profitable, which may mean it's able to reduce the price for the customer and perhaps sell more. It's certainly the case that it's able to have higher entry barriers to potential competitors. If a business is vertically integrated and is able to control the raw materials, then of course it can refuse to sell to potential competitors. Bearing in mind, of course, this may be illegal if it's against the public interest, if it's against the interest of the customer. But certainly potential competitors will be in a position where it has to buy raw materials from a competitor. And that means, of course, the business is in a better position to block potential competitors. And finally, it's able to expand its core competencies. The core competencies is what the business can do best. It's the efficiencies that are within the business, the skilled workers and the specialized machinery and the specialized research and development and so on. So it's able to expand those, and it's able to look more fully at all aspects of the business, from the production of raw materials through manufacture to retailing. So it's able to expand the core competencies and perhaps in that way get an even stronger foothold on the market. Now, those are some of the advantages of vertical integration. As you'd expect, there are disadvantages. First of all, there might be capacity issues. Upstream capacity must match downstream operations. It must be the case that capacity is balanced right throughout. If raw material production is significantly more than that required in, say, production, then there may be a wastage. That is, it's a wasted resource. There may be idle capacity at one level. Or it may be that the customers their demand is highly variable, and at some times they will buy a lot, at other times they won't buy so much, so there may be excess capacity at certain times of the year. So there may be capacity issues. So management of the supply chain makes it easier, but at the same time the supply chain will have to be adjusted in accordance with what the market will take and the different capacities at different levels in the supply chain. Lack of supplier competition could result in higher costs. Competition promotes efficiency. Lack of competition may mean that the business becomes sloppy, it becomes casual. It doesn't look for efficiencies. It doesn't have to. It doesn't have competitors. It's got rid of the competitors, perhaps. In which case, it's not trying that hard. It doesn't innovate at the same rate. It doesn't have the same pressures, market pressures. So perhaps it becomes less efficient and high cost. It could be that in the process of integration it acquires new core competencies, new talents and skills, but perhaps these will replace the existing ones, or maybe they crowd out, they deter the expansion of existing core competencies. The research and development department, for example, may have a particular set of skills in certain areas. Well, when the business expands, those set of skills may become a minority in the new expanded business. This may demotivate the staff and they may not feel the same commitment to the business. The business now is much bigger and has got a different emphasis. Before, they were the centre of attraction. They were the ones that everyone looked to for new ideas. Now, perhaps they're being lost in a much bigger business and much more activity within that department. And this also applies in different departments. Marketing may have a particular skill, and when the business vertically integrated, took on raw materials and the final market or production, or however it integrated, the marketing section may become small. The original marketing section may become small, insignificant. They may feel like they're not valued anymore. They may become demotivated. They may not be trying too hard. So there's an issue in looking at the core competencies and managing the core competencies when the business does change. Product variety may be reduced unless the integrated business engages in active and continuous research and development. It's essential that the business looks at research and development in order to promote the long-term future of the business. Well, if the business becomes vertically integrated and powerful in the market, it controls raw materials, production, let's say, and it controls the final outlets for the product, then the business may become complacent. It thinks it's got a product, it's selling. Why work hard? Why push for new developments? New developments means more work and more hassle for the management. So just do as they're doing. Long term, that means that the consumer will not get new products. There will be less innovation, less development in the market. And that's to the detriment of the business and to the detriment of the market. Now, these were some points on integration, horizontal integration, moving at the same level, say distributors of the product merging, that's at the same level, that's horizontal, or vertical, where a business moves closer to the customer, perhaps buying up retail outlets if it's a manufacturer, or backward integration if it's a manufacturer going back and buying the sources of raw materials. But these are the advantages and disadvantages of this type of activity. And that's all really I want to do in this session, is to look at the advantages and disadvantages of forward and of horizontal and vertical integration. So the advantages and disadvantages of horizontal and vertical integration. So I'm going to leave it at that and say thank you for watching.